Jai Hind everyone. Welcome to my YouTube channel, which is Explore Yourselves, Banking and General Knowledge, etc. Today I will discuss two group discussion topics related to the internal promotion examination for banks. Welcome to part 7 of my Path to the Corner Office 2025 to 2026 series, where we break down real bank promotion exam questions and give you clear practical sample answers about group discussions to help you climb the career ladder faster. Group discussions topic. First, inflation and its impact on the banking sector. Second, the role of banks in promoting sustainable development. Inflation and its impact on the banking sector. Inflation, defined as the sustained increase in the general price levels of goods and services, has far-reaching consequences on the banking sector. While moderate inflation is considered a normal sign of growing economy, high or persistent inflation can create economic instability, reduce purchasing power, affect borrowing and lending decisions, and influence banks' operations, profitability, and risk management strategies. The impact of inflation on banking is not entirely negative. It has both opportunities and threats. A balanced evaluation helps in understanding how banks adapt and what challenges they face during inflationary periods. Pros and positives and arguments in favor of inflation for the banking sector. Inflation can have certain positive effects on banks. One major advantage is that banks can improve their interest margins during inflationary periods. When inflation rises, central banks often increase policy rates. Higher lending rates can result in higher income for banks on loans, improving net interest margin. If deposit rates do not rise at the same pace, banks enjoy a spread that boosts profitability. Inflation also increases the demand for credit. Businesses need more funds for working capital because input costs rise. Consumers may borrow more to buy durable goods before prices increase further. This expanded credit demand can contribute to higher loan disbursements and income for banks. Another positive is that inflation reduces the real value of existing debt. Borrowers repay loans with money that is less valuable in real terms, reducing the actual burden. This indirectly reduces the default risk for some borrowers because inflation erodes the value of fixed payments. Inflation also encourages people to save more in interest bearing instruments. As banks raise deposit rates to attract funds, customers are motivated to shift money to term deposits, which can improve banks' liquidity and stabilize their funding base. For banks, in certain assets like gold related instruments, inflation can boost asset values, resulting in better returns. Cons and negatives and arguments against inflation for the banking sector. Despite some advantages, inflation poses significant risks and challenges to banks. The biggest negative is the increase in credit risk. As prices rise, customers' purchasing power declines, making it harder for them to repay loans. Business borrowers face higher input costs, lower margins, and reduced consumer demand, leading to delays, defaults, or restructuring requests. This can eventually increase NPAs, non-performing assets, weakening the bank's balance sheet. Inflation also raises operating costs for banks. Salaries, rent, utilities, and technology expenses increase, reducing profitability. Maintaining physical branches becomes more expensive, and banks struggle to keep operational efficiency intact. Another major challenge is pressure on deposit mobilization. When inflation is high, real interest rate minus inflation, become negative. Customers might shift money into gold, real estate, or mutual funds instead of bank deposits. This causes liquidity stress, making it harder for banks to fund credit growth. Additionally, inflation creates interest rate volatility. Rapid policy rate changes by the central bank affect banks' asset liability management. If a bank has a large portfolio of long-term fixed-rate loans, rising interest rates can reduce the value of these assets. Foreign exchange volatility, often linked with inflation, exposes banks to currency risk, especially those with foreign borrowings or cross-border operations. Finally, high inflation reduces investor confidence, impacting the stock performance of banks, their ability to raise capital, and their valuation in financial markets. Balanced comparison. A nuanced evaluation. Inflation affects banks in both positive and negative ways, depending on its intensity and duration. In a moderate inflation environment, banks benefit from increased credit demand and better spreads between lending and deposit rates. This environment supports bank profitability, improves margins, and encourages economic activity. However, when inflation becomes high or persistent, the negatives outweigh the positives. People's savings decline, deposit growth slows, and banks face liquidity constraints. Higher borrowing costs discourage new loans, while existing borrowers struggle with repayment. This combination increases credit risk and reduces asset quality. For banks, inflation also affects strategic decisions. They must balance interest rate changes, manage asset liability mismatches, and maintain customer trust. The central bank's role becomes crucial. Raising rates to control inflation also makes loans expensive, slowing economic activity and indirectly affecting banking performance. From a borrower perspective, inflation reduces real incomes, making EMIs harder to service. From a depositor perspective, inflation reduces the real value of savings, from prompting them to demand higher deposit rates. Banks must carefully adjust pricing strategies to strike the balance between retaining depositors and maintaining profitability. In a broader sense, inflation shapes consumer behavior, investment patterns, and expectations. Banks must continuously innovate through digital banking, automation, and optimized operations to offset rising costs and maintain competitiveness. Thus, inflation is both an opportunity and a risk for the banking sector. The outcome depends on how effectively banks adapt and how well policy measures control inflationary pressures. Arguments for positive side of inflation. Higher interest rates can increase bank margins. Increased borrowing needs due to rising costs can boost loan volumes. Inflation reduces the real value of existing loans. Higher deposit rates attract more savings. Asset values, especially gold or inflation linked securities, may rise. Arguments against negative side of inflation. Decreased repayment capacity increases NPAs and credit risk. Operational costs rise significantly. Reduced real returns discourage deposit growth, causing liquidity issues. High interest rates slow credit growth and economic activity. Volatility in markets affect asset values and investment portfolios. Conclusion. A balanced perspective. Inflation and the banking sector share a deeply interconnected relationship. While inflation can increase interest margins and create opportunities for credit expansion, its adverse effects are more disruptive. High inflation erodes purchasing power, increases credit risk, slows deposit mobilization, and threatens the financial stability of banks. A moderate level of inflation may support growth, but excessive inflation demands strong monetary policy intervention to safeguard the economy. The true challenge for banks lies in managing these risks through efficient asset liability strategies, digital transformation, diversified income sources, and strong credit assessment practices. Policymakers must ensure that inflation remains within a manageable range, allowing banks to function efficiently without facing excessive pressure. In conclusion, inflation is neither entirely harmful nor beneficial for the banking sector. It is a complex economic phenomenon that demands careful management, strategic planning, and strong regulatory oversight. A stable inflation environment remains the most favorable for healthy banking operations, sustainable growth, and long term financial stability. Role of banks in promoting sustainable development. Sustainable development has become a global priority as countries strive to balance economic growth with social welfare and environmental protection. In this context, banks play a crucial role in financial intermediaries that mobilize funds, influence investment patterns, and shape national development agendas. By directing credit toward green projects, supporting socially responsible businesses, adopting ethical governance, and integrating environmental, social, and governance principles, banks significantly contribute to sustainability. At the same time, the transition to sustainable finance comes with challenges such as higher compliance costs, risk of greenwashing, and reduced profitability in the short term. Thus, the role of banks in promoting sustainable development is both transformative and complex, requiring balanced analysis. Positive role and pros and arguments in favor. Banks have tremendous influence on economic activities, and when they align with sustainability principles, the impact is widespread. A major advantage is that banks encourage environmentally friendly practices by financing renewable energy, electric mobility, waste management, green buildings, and other sustainable ventures. This redirection of capital leads to long-term ecological benefits, reduced carbon emissions, and efficient resource management. For instance, many banks now offer green loans at concessional rates to promote solar panel installation, energy efficient machinery, and water saving infrastructure. Another positive aspect is the support banks provide for social development. Through microfinance, priority sector lending, and financial inclusion initiatives, banks help uplift marginalized communities. By offering affordable credit to farmers, women entrepreneurs, self help groups, and small businesses, banks strengthen livelihoods and reduce inequality. Digital banking and accessible financial products also help bring millions into the formal financial system, enabling more equitable growth. Additionally, banks promote sustainable corporate behavior by integrating ESG principles into their lending and investment decisions. When banks demand sustainability disclosures or environmental risk assessments from borrowers, companies are compelled to operate more responsibly. This leads to better governance, transparency, and accountability across industries. From a strategic viewpoint, sustainability enhances long term financial stability. Climate risks, environmental damages, and social unrest can severely impact loan portfolios. Therefore, banks can proactively support sustainable development, reduce long term credit risks, while building more resilient balance sheets. They also improve their global reputation, attract responsible investors, and stay compliant with evolving regulations. Negative aspects and cons and arguments against. Despite the benefits, there are challenges and drawbacks that limit the ability of banks to fully integrate sustainability. One significant issue is the high cost of transitioning into sustainable practices. Banks need to invest in new assessment frameworks, risk evaluation models, staff training, ESG auditing systems, and regulatory compliance. These expenses may affect short term profitability, especially for smaller banks. Another concern is the risk of greenwashing, where banks or borrowers falsely present projects as environmentally friendly to gain financial benefits. Without strict monitoring, sustainable finance may become a marketing slogan rather than a meaningful commitment, which can mislead stakeholders and undermine public trust. A further challenge is the limited awareness and expertise both within banks and among borrowers. Many sustainable technologies are still emerging, and banks may hesitate to finance them due to perceived risks or a lack of technical understanding. Similarly, businesses may find it difficult to meet ESG requirements, making it harder to access sustainable financing options. Additionally, in developing economies, banks face a conflict between supporting rapid economic growth and enforcing environmental standards. Industrial development, infrastructure expansion, and real estate growth, often major lending areas, may not always align with sustainability norms. If banks tighten lending criteria in the name of sustainability, it could slow economic process or disproportionately affect sectors that are essentially but environmentally intensive. Lastly, customers may also resist sustainable banking practices if they lead to higher interest rates, additional documentation, or stricter evaluation processes. This can create friction between short term consumer expectations and long term sustainability goals. Balanced comparison. When evaluating the role of banks in promoting sustainable development, a balanced perspective shows that both benefits and challenges coexist. On the positive side, banks have unmatched influence in shaping national development patterns. Their financing decisions can accelerate the adoption of clean energy, foster inclusive growth, create green jobs, and ensure environmental protection. Sustainable banking also enhances long-term financial stability, reduces climate-related credit risks, and helps banks align with global standards such as the Paris Agreement or SDGs. However, the limitations are equally important. Transitioning to sustainable banking requires substantial investment, operational changes, and skill development. Banks must balance profitability with responsibility, ensuring that sustainability does not become an administrative burden. The risk of greenwashing poses reputational threats, which, while stricter norms may reduce access to credit for some industries, particularly those in early stages of transformation. Furthermore, sustainable development requires collaboration, not just the effort of banks. Governments must create supportive policies and incentives, companies must adopt greener practices, consumers must shift to environmentally conscious behavior. Banks alone cannot drive change, but they can act as a catalyst. Thus, the effectiveness of banks in promoting sustainable development depends on a holistic ecosystem and the level of commitment shown by all stakeholders. When banks combine innovative financial products with transparent governance and strong risk management, the benefits far outweigh the challenges. Conclusion. Banks are vital players in the journey towards sustainable development. Their ability to mobilize capital, influence corporate behavior, and support social welfare places them at the heart of economic transformation. While there are obstacles such as high compliance costs, limited awareness, and risks of greenwashing, the potential benefits are immense. By supporting clean energy, green infrastructure, financial inclusion, and ethical governance, banks contribute to a more resilient and equitable future. A balanced view reveals that the transition to sustainable banking is not merely a regulatory requirement but a strategic necessity. Climate risks, environmental degradation, and social inequality pose long term threats to financial stability. Therefore, banks that proactively embrace sustainability are better positioned to protect their portfolios, enhance customer trust, and promote national development. Ultimately, sustainable finance is not just a responsibility, it is an opportunity for banks to redefine their role and lead society towards a healthier, greener, and more inclusive future. Thank you very much for your patience. Please like and share this video and subscribe to my YouTube channel.